Office Depot, Office Max, and Staples all closed heavily in the red. This after Office Depot agreed to buy Office Max for $1.17 billion. The all-stock deal would create a company with a combined revenue of $18 billion. The move combines the number 2 and number 3 office supply retailers and leads to consolidation in an industry that analysts have said for years has just too many physical stores. The deal is aimed at competing with the largest office supply player, and that's Staples. The office supply store sector has been hit by a rise in competition from web retailers like Amazon and discounters like Walmart and Costco. While the Office Max Office Depot merger is just the latest in a string of mergers and acquisitions so far this year, in fact, over the past few months, companies have been buying each other up at the fastest rate since the start of the Great Recession back in 2008. Liling explains how these deals are impacting the economy.
From the $11 billion deal between American Airlines and U.S. Airways to billionaire investor Warren Buffett's $23 billion purchase of food giant Heinz, merger and acquisition deals, or M&As, appear to be all the rage again. Flush with cash from cost-cutting during the past few years, low interest rates, and a strengthening stock market, companies now have a renewed appetite for risk-taking. With some $160 billion of deals announced so far this year, that's twice the M&A activity from the same time a year ago.
It's still very inexpensive to borrow money for companies that are big companies that are considered creditworthy. And in many cases, they've already got a lot of money. So you've got availability of cash. The next thing you've got is a perception that the economy's getting better. So if you buy something, you don't have to be as nervous that the economy will cause whatever you bought to become distressed.
Among the most talked about deals, the Office Depot Office Max merger, the American Airlines U.S. Airways deal, Berkshire Hathaway's acquisition of Heinz, the $24 billion leveraged buyout of Dell, and Comcast's purchase of General Electric's remaining stake in NBC Universal. The deal activity has propelled U.S. benchmark indices to record highs this week, with the S&P 500 closing Tuesday at the highest in 5 years. And that optimism on Wall Street is spilling over onto Main Street.
Mergers means activity, activity means progress, so I feel good about that.
I feel like it's a sign of better things to come, actually. I think there'll be more acquisitions coming, and I think it'll make things better.
Optimistic, 100% optimistic, and I think the more transactions and the more opportunities ultimately rise to the top.
And that's what investors are counting on, the growing sense of confidence about the economy that could make for a significant mergers and acquisition cycle.
And for more insight and analysis on what all this M&A activity means, we've got Liling live at the NASDAQ market site with us. Liling, why is this M&A activity seen as a positive by the overall economy?
Well, broadly speaking, it's a signal that investors are growing more confident about the U.S. economy. And, to get a sense of that, let's look at two of the major deals so far. We have Warren Buffett, and of course, anything Warren Buffett does, investors watch closely, and more often than not, they follow. And the acquisition of Heinz at 20% over what was last traded, that is an indication that there's confidence not just in the food giant Heinz itself, but also in the sector. Let's talk about Dell. Michael Dell's move to take the company private in the $24 billion leveraged buyout. Investors are watching to see if that could prompt other similar types of leveraged buyouts. So that's getting investors quite excited.
It's all been viewed very positively, although we did have all the 3 players in the Office Depot, Office Max, and Staples shares closed down today. That could just be due to market volatility. There's a lot of optimism, but is there any flip side to this coin? Are we being too optimistic, perhaps?
Well, there are certainly some more conservative points of views here, but most of the people I spoke with are optimistic that this is a trend that could hold for a while. 3 main reasons for this. The first is that, well, on one side you have companies that are sitting on an unprecedented amount of cash, and second, and compare that with companies that are facing growing challenges. So they, at the same time, they make prime takeover targets. Secondly, interest rates are really low, borrowing costs are low, and thirdly, stocks are doing well, which means companies can use their own stock to buy other companies, although that could also mean that target companies could be more expensive. So there's some risk-taking there.
What about jobs? What does this mean for the job market?
Well, for jobs, anytime there's mergers and acquisition deals, jobs take a hit because companies want to grow profit, trim the fat, so that translates as layoffs. So generally, jobs not so good when it comes to mergers and acquisition.
So no upside there. Liling, thanks so much for joining us in the studio.